Okay, so catching up with the market on the intraday. We expected the seasonal push to the downside for September, and we ended up stopping right at the bottom on the 30th of September. Had a little bit of a gap down for October 3rd, but immediately started pushing. And that seasonal push for the very first week of October was to be expected. So here I have the seasonality chart up in front of us, and the main moves to pay attention to are on the red, the green, and the purple line because they coincide with basically all of the conditions that we're currently trading in. The blue refers to all midterm years, and the black line is the average since 1946, which is, of course, skewed because most bull runs last for several years, whereas bear markets only last for 1 to 2. So you always see the market on average moving up, but during these specific financial conditions that we have, which is definitely a bear market, the most extreme of them happening after the second year of a new Democratic president entering into office and then going into the presidential midterm election, we see consistent patterns that have matched up with our market almost perfectly. We had a sell-off going into January and March and a brief rally up until the end of April, which then saw huge selling until mid-June. At exactly June 17th, we bounced and then went on a rally up until mid-August and then sold off again throughout September, all the way back to our original point where we retested lows at the end of September. And then we've had this really brief rally here for October. And by mid-October, we expect another sell-off for us to create a new lower low. And you'll notice this is pretty consistent with almost all of these charts, where you see lower lows showing up in October following a September sell-off. And then once we finally get to the end of October, that's when we enter our holiday rally, which has been consistent across all years. That once election season is basically behind us, we go into Thanksgiving and Christmas. That's when the market starts to recover and we see greater faith in equities. The only problem with this is that now we are running into a very rare market. We have rare financial conditions that are actually matching up with a former crisis that we saw before. And this is part of the talks that I'll be touching on later on in this recording. But we're currently dealing with a collateral crisis in the treasuries market, or specifically a liquidity crisis in the treasuries market, which is going to lead to a collateral issue. But before we get on to that, kind of want to map up what we got for next week with the SPY. You can see that we've now been moving down for a while, and we've retested our 200-day moving average right here. We were hanging out above it very briefly before we had formed this diamond top pattern, which was beautifully called out by the analyst team here at Hell's Trading Floor. Big thanks to Tempestuous Persephone and Logical Chaos for catching that in real time. But once we had this diamond top pattern and then we broke through and headed to the downside on Friday, this basically signaled we signaled a full day in advance that the market was going to be moving down and that we would see a huge drop in the SPY, which thankfully most of the floor captured this entire move, which was absolutely fantastic. So what can we expect for the following week? I'm estimating that for the first part of the week, we'll probably get a little bit of chop, maybe even a rally for Monday. It would be the right conditions for it since we've now created a higher low on the RSI. This move was not as extreme as the previous move, so now we've kind of established at least a little bit of support here for the relative strength index. And here on the MACD and the PPO price cloud oscillator, we can see that there is a MACD cross that is pending. So at the very least, I'm expecting a little pop in the SPY, at least for Monday. But whether that's going to last is not sure yet. So we'll have to see how Monday shakes out before we can really get a clear picture of what the market is ready to do. But we're going to go and take a look at some of our other indicators to see if we can map this out. So take a look at HYG. We can see that the SPY put in a higher low yesterday, but HYG put in lower lows. So we had this continuous drop in HYG, and we can see that the momentum indicator is still very bearish, and it's still pushing the price cloud further lower. And we're getting continuous hidden bear divergences along the RSI here. So HYG, that's the junk bonds market, is signaling for the market to continue to the downside next week early on. What I just deleted and probably should not have was that we had a matching diamond top in this, and HYG broke before the SPY did. As well, we had this bear flag intraday that signaled the SPY was going to move even further down. The SPY was selling off pretty aggressively, but it really got kicked off in the afternoon. Once we had passed the lunch hour, HYG started dropping fast, and it signaled the SPY almost a half hour early. So once again, HYG remains dominant as the leading indicator for what the S&P plans to do intraday. And this consistency has really been saving us, I've noticed. So now we're trading well below all of our moving averages on the 5-minute chart. On the hourly, we're now getting rejected by the 200 moving average, and we're going to likely see a rejection of the 50 and the 200. If this does manage to cross, we might see a little bit of a pop on Monday. Again, if we do see a pop in HYG, then I would expect that to signal for the SPY to also match up with that. However, what I'm noticing is that the momentum indicator is strongly moving to the downside, whereas the SPY is looking as though it's going to cross. So unless the HYG turns around quickly, I would expect any rally in the SPY to be very short-lived. Over on the VIX 1-hour chart, we can see that the VIX has finally put in a bottom here after establishing a series of lower lows on its after its big run where we saw the market dump all throughout September. These lower lows have finally put in their last lower low, and we had seen our first higher low on the 6th of October right here. So this divergence was very, very, very close on the RSI. I think I would have actually counted this. The price movement was so close. But I would have definitely called this a bullish divergence. I know that the RSI TMI divergence indicator isn't calling it, but I think that that's close enough. It's a very subtle difference. But this definitely signaled a move to the upside, which we saw selling off in the SPY. So this move in the VIX actually came back on Thursday. Actually, as soon as the VIX started moving in higher, it set up its first higher low right here, and we've been moving up ever since. Now we're setting up a lot of wicking action. There's a lot of wicking here at this resistance at $31 for the VIX. We've seen this before. So the last time the VIX challenged this resistance, we had been wicking through it several times, creating a lot of chop before we had one big plunge in the market at the very end of September, and then it rebounded at the very end, or rather, I would say that the market cooled off and started moving sideways, allowing the VIX some time to cool off. Moving back to the VIX daily chart, I'm looking for any signals that the market has essentially topped and that we could be seeing even further lows in the broader market. So what I notice is that here we have the VIX bottoming out and then creating higher lows after a long period of bullish action in the market, where the VIX was channeling down towards this floor, and then it bounced off of it 3 times in a row back to back before putting in one higher low, and then we had, of course, the COVID crash. Now, what I'm seeing here is that we've bounced off of this floor several times. 1, 2, 3, 4, 5. And then we put in a higher low here. A higher low here. And just barely a higher low here. And I don't know about you guys, but this all looks to me like consolidation. Like the market's getting ready for a big move. I've been consistently seeing the VIX challenging.
Wedge, right? So, yeah.
What's that, Phil?
It's in a wedge, so yeah, I agree with you. It's bouncing back and forth in that range. So yeah, I guess it's a form of consolidation, right?
Just looking at all the times that we've touched this resistance line on the top of the wedge, the VIX has spiked through it 1, 2, 3, 4 times. And then we had one touch on a 5th time on this last move to the downside. We got to be getting close. The market's really hating the action lately. The Fed is refusing to pivot, which I kind of applaud them for. I thought that they would give up by now. I was just hoping that they wouldn't, because it feels like it's the only thing that's going to have a chance of keeping the economy stable over the long run and not give in to inflation.
Yeah, but it's still very challenging. I still think the odds are in favor of a pivot at some point, unfortunately. You're right for the long run, but when the pension funds start screaming,
yeah,
and the economy is collapsing, it's going to be a really tough thing to do.
Yeah, it's a very real concern. The Bank of England is still. Last I heard was they were reversing their decision to pivot, and I'll have to pull up the story on it for our talk a little bit later after we're done covering the market. What I think I'm hearing is that the Bank of England, the central banks, have all agreed that there's no tolerance for inflation at this pace, and that if they don't do something about it now to get it under control, that it's going to just lead to massive economic collapse globally, which it would just lead to a far worse situation than they're in right now. And I think they're finally coming to terms with it. So I'll pull up that story.
Maybe I'm wrong. Okay, so maybe the Fed was waiting to see what would happen, how the results were of the Bank of England, and then start from there.
Well, all of the Fed chairs had come out in response to every time they had been asked during their calls, their meetings, any interviews they had been in, is that we are committed to fighting inflation and we are not going to stop until that's done. And that's very strong hawkish language, considering how much interest rates have been risen, which, I'll be frank with you, our current interest rate is very neutral. But yeah, they've been insistent. So that at least does signal to us that they are going to keep fighting inflation, and that we should expect the stock market to crash as a result. It's just a natural consequence of it. We've grown too far, too fast, and now we have to let markets cool off. And the euphoria was just too strong. It was insane. Let's move on to the Qs and take a look at where NASDAQ is currently at. The Qs have put in a lower low, but now we have actually hit a double bottom. So this is kind of what makes me think that we're going to see a little bit of a pop next week. But we haven't gotten a confirmation candle back to the upside yet, so it's still way too early to tell. But on the daily chart, you see we have this one red candle down here, and we have another red candle that has set up this close with a lower body that is just within the range for a double bottom. So if we do end up seeing a turnaround tomorrow on Monday, then the assumed price take profit would be somewhere around 280 for the Qs. It's too early to tell, because this last move to the downside, this one candle had far more volume than the volume of its previous candles that week. So clearly the movement to the downside is a lot stronger, and we've almost set up lower lows, which honestly, this one candle dwarfs all of these others. There's no other candle in this chart for the last 2 weeks that comes close, except maybe this one from the 21st of September. So this was a pretty huge bearish turnaround for the entire market, especially in the tech sector. Bulls kind of got slaughtered on this bull trap. Catching up on the real estate market, I had gone short on DRV and definitely made a huge mistake. I was thinking there would be a seasonal rally in DRV and was proven way wrong. So this is me taking my lumps. It was a small put position, but I entered into a put position on DRV to play this to the downside, and I expected the DRV to just kind of bleed off and for the real estate REIT market to kind of go sideways for a while, and I was going to try and capture some profits. That did not happen. DRV instead blew off top and went and created a new higher high. The volume is even stronger now, and now it's too late to enter a position. So, well, that was a bad idea. As it turns out, the market even rug pulled me a little bit, even as a bear, even as bearish as I am. I wasn't expecting it to crash this hard, but yep, should have seen this Morningstar pattern, and at the very least gotten out of my position after this hammer candle, but did not take that opportunity. But we'll see how it goes. I'm holding on to that position for some time now, so there may be an opportunity for me to exit that later on. Maybe re-enter in for a short position on the XLRE. As most of the as all of the trading floor should know, I exited that position, taking profits very, very near to the bottom. I got out not last week, but the week before on Thursday. That exit was extremely profitable. We had been shorting this thing down ever since we had hit a top at around $44. So still very happy with the trading action on XLRE. The entire market has been more or less doing exactly as we expected it to, with the housing market continuously moving to the downside as inventory surged, as lending standards increased in their stringency, and as mortgage rates continue rising along with the 10-year bond yields. Speaking of the bonds, let's catch up on what the 10 and 2-year yield curve are currently doing. So right now, it looks as though to me that our 10 and 2 yield curve has been basing in this area for a while now. Since we had hit it in August, when we hit the top of the market in August, and as soon as we started seeing the market crashing, all of the bond yields started to uninvert for a while, and then we had another big move in the opposite direction in late September. So I'm still waiting for the yield curve to uninvert before calling for a major market crash. Like, we need to see the yield curve uninvert before we expect capitulation. This has been a consistent signal that capitulation is coming within a 3 to 12 month period from the time that the uninversion occurs. So at the moment that this line crosses the zero to the upside, that's when the timer starts. And this has been consistent with basically every major crash that we've had since the 60s. That every time the yield curve has inverted, it took until the yield curve had uninverted, and then a 3 to 12 month wait time before the actual big crash where the market moved straight down in like a rock falling out of the sky. So right now, seeing the yield curve basing like this has got me thinking, okay, like now I can see that the bonds are starting to find their base, and we should expect to see yields moving up in the 10-year really quickly, right? And that's kind of what I've been waiting for. And now the 10-year yield is beginning, just very slowly beginning, to recapture lost ground after 2 weeks of 2 weeks of big buying in the wake of the Bank of England central bank's notice and outcry for all the other central banks to pivot. So currently, it looks as though the 10-year bond yields are back on the rise, and if they outpace the 2 years more quickly than expected, then we could see the 10 and 2 year uninvert in a couple of months. And if we did get that, then I would basically set myself up for my first entry into what I anticipate will be the big wave crash, looking for signs that that is about to take place as early as possible. So far as we look at the yields and how they stack up, we still see that the 2 year is still inverting the 5, the 10, the 20, and the 30, but all of the T-bills and the notes are beginning to uninvert. So the 1 month is very close to the 3 month and the 6 month, and the 1 year is no longer inverting the 2 year. So that was something that we had seen before, where the 3 month and the 6 month had actually inverted each other. The 6 month was inverting the 1 year. That was probably the most extreme bond yield inversion that we had seen yet, but we're still seeing pretty extreme yield inversion between the 2 and the 10. And on record, I have to make mention of this also. If you go back to the weekly, or we'll just go to the monthly, this is the deepest inversion that we have had since the dot-com era. The only one that was even worse than that was back in the 80s. I don't know if anyone here is able to remember that, but that was a time when you couldn't afford to get a house because interest rates on mortgages were like 18-20%. You just couldn't get a loan. That is the danger of stagflation. If we were to ever go back to that, then I don't think that this country would economically survive it. Stagflation isn't something that we can tolerate because there's no way for our Fed to use its monetary policy to save us from stagflation if that were to occur. Before they had plenty of assets, the country had a lot of value in intrinsic assets. We had access to all of our various internal resources. The U.S. was making its own oil at the time. We had a lot of property. We had the ability to create all of our own goods and necessities, food and such. We're so reliant on the global economy now that if we were to experience stagflation, then I don't think that the dollar would survive it. We would probably see a huge. I mean, I know that this is like getting into the realm of the extreme, but economic apocalypse. We don't want to go back to a time like that. We don't ever want to see stagflation with us being so far in global debt. Let's go review the rest of the stock market. Take a look at the heat map. Unsurprisingly, the entire market was massively red on the day. Let's go ahead and take a look at the weekly. So by far, energy was the winner last week, and we should probably expect this to continue. Actually, the energy market is experiencing a huge surge with oil continuously pushing prices of various oil-producing stocks up. And this is going to probably push inflation a little bit further as well, so we should be prepared for that. Most of the other sectors, particularly finance, health, producer manufacturing, and consumer services, were relatively mixed. Consumer non-durables were more or less red. There's a few stocks that are still big performers like Nike and Monster that were doing well in that sector. The technology services, again, very mixed between social media and, services like CRM, Salesforce, Google, Adobe, all still doing relatively well on the week. But now we're starting to see pain across the utilities sector, and Tesla. Tesla was absolutely brutal. Sold off 16% over the course of the entire week. So as far as my plan for trading the SPY tomorrow, I'm probably going to wait to see how the market reacts at open tomorrow to see if we do get this little pop, and just judge based on how strong that move is. If we do get a big move to the upside and we cross above the 200 moving average one more time, if I see at any point that we're crossing the 200 moving average on the 1 hour chart, then I will likely go long in the market intraday, or if it's a weak move to the upside, I'll stay out of it until it peters out and starts to show consolidation similar to what we saw here, before going short on the market on the first big move to the downside and follow that down for the rest of the month into November. As I said, with seasonality, we're expecting that from about mid-October onward, we should expect the market to sell off to the downside. So, do you guys have any questions or any tickers that you would like me to go over? Oh, PayPal, yes. PayPal was one that a couple of folks were asking about. It's had some steam for a while, but now in this market since August, it's kind of like it's held some of its gains, but it looks like it might be getting ready to give up some of them. So we had been trading. Okay, this was a channel, and we broke low on this move to the downside, and then tried to recapture, and then never retested the channel. So this little gap, we broke the low of this channel, right? And then we tried to recapture the top, but failed. There's this little gap here before it could reach the top of that channel. That indicates to me that the strength in the move is gone. That spells disaster to me, actually. Looking at the 1 hour chart, I see all the moving averages are consolidating pretty closely together, and they have been doing this for a while now. But the moves in PayPal seem to be getting continuously weaker. There is this risk of the moving average convergence divergence crossing above, so if we see a strong move to the upside, then this may cross up. But if we do see that and the move is weak, then we might see the price only get a little bit higher before coming back down hard and retesting the lows. If we don't see that and instead the MACD rejects, then this may get pushed down very quickly, and it may even break the channel. If we see a break in that channel, then we may see PayPal dropping far and fast. There's actually a lot more bearish indicators on this because of the bearish divergence. We've got bearish divergence here and here, with the RSI making lower highs back to back as the price was moving up. This was actually pretty accurate. That would have seen, let's see, how much would we have taken if we had entered in on that bearish divergence? That was a 5% drop, 5.5% drop. Yeah, I do like this. PayPal does look very weak. Let's take a look at the daily. All right, so the MACD crossed up and the price cloud is getting very tight. We've been making higher lows with this last higher low. This one was an extremely close one to this. Lower highs.
So, Katie, did you see the news on PayPal talking about, looks like they recanted their statement, but they were basically going to start fining people $2,500.
Really?
That's what drew my attention, yeah. But
They're going
and
to
that's what
fine
was all
people
over.
for what?
I have to go look and find,
Yeah.
but I think it had something to do with the like hate speech, but they don't like what you're saying. They're just going to take your money.
Really?
Fine you.
If you
they
check
backtracked on that.
If you check the Demon's Floor, put out like the headline, the new PayPal policy lets firm fine users $2,500 for spreading misinformation, TOS, condemned and colon abomination. They pulled it back though. But I think that might have been something to do with the drop on Friday.
Interesting.
And it seemed like a lot of people were just like, I don't care if you recanted it. I'm canceling my account anyway.
Yeah.
Well, they said it was a mistake. Wink, wink.
Yeah, exactly.
Yeah, of course it was a mistake. It lost
Of
your
course.
customers. Dumbasses. All right. Let's see if we can find any consistency between PayPal's previous moves. So we had this entire bull market rally running from 2020 up until late 2021. And then we hit the top of the market. Looks like we hit the top of that market twice. Right here at 311. Man, imagine shorting this at the top of the market back